What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 22nd of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk about a very important topic, and that is the concern that many investors have on where they should park their wealth. Well, even though I won't be able to be your financial advisor and give you direct financial advice, I will show you some tools and techniques that I use personally to be able to find where's the best place that I can park my capital to discover yield. And it's a very important question. Sometimes savings or having your money in cash may be the better option. So we're going to be talking about all of this as we go throughout our video right after our quick sponsor. Our sponsor for today's episode is TaxBit. The IRS recently released new forms in 2019 that require all taxpayers to attest to whether or not they traded cryptocurrencies, no matter if they made gains or losses. TaxBit automates your cryptocurrency taxes, enabling you to effortlessly track, calculate, and report your transactions. Easily connect your exchanges to securely sync your transactions and run them through TaxBit's tax engine. Generate your completed tax forms with a single click. Founded by tax attorneys and CPAs, TaxBit is the most trusted cryptocurrency tax solution. Get 10% off your tax plan today with a free trial using promo code DataDash. Alrighty, so to start off, I want to go ahead and share the article that really kind of served as a precursor for this discussion of wealth preservation. So one of my favorite investors that I look up to, Ray Dalio, recently came out with statements that he believed cash is trash. Now, of course, all the media outlets love to find little snippets and sometimes take them out of context. For example, one time the media made it seem as if Ray Dalio was absolutely bearish on equities and was predicting an impending recession in equity markets simply because he took a put option that basically hedged his long positions that were obviously where he's mainly exposed to. So again, I don't want to oversimplify it here, but Ray Dalio did make a very clear point here. And that was the fact that he believes right now, with the current state of Fed monetary policy continuing to expand the credit cycle that we've already been in for the last decade and printing a ton of funny money, in this case, it's probably good to be exposed into some form of assets. And he primarily seems like he's interested in equities, which is the market that he mainly invests in through Bridgewater Associates, one of the largest funds in the world that he's founded and run for a long time. And this is quite contrarian to what we've seen with companies like Berkshire Hathaway, run by Warren Buffett, that right now, even though they are still, like I mentioned earlier, similar to Ray Dalio, net exposed to equities, they're not going to be selling hundreds of billions of dollars of positions, not to mention dumping the other hundreds of billions of dollars of assets that they own outside of equities. But they have a $128 billion pile of cash that is depreciating in its purchasing power as it sits there and as the Fed continues to of course, increase the supply of the currency. So between these two contrarian views here, obviously Warren Buffett has taken a position where cash is where it's at right now. There's not value in the market, and because of that, he's not making any large purchases or investments. And then also Ray Dalio is on the other end saying, look, you better get that cash somewhere. It better be getting a yield somewhere. So this is an important question here. What is the right answer here? Is Ray Dalio more in the right ballpark, or is it more of Warren Buffett's philosophy? Well, I would say it's dependent to a degree. I would say that I lean more towards Ray Dalio if you honestly want my take on it. Again, I can't give you guys financial advice, and another video will be about financial advice specifically, but I'll show you all some different routes and some different things you can look into yourselves. I'd say that I lean more towards Ray Dalio because I understand that it's not good to bet against Fed monetary policy. And right now, it seems like the Fed, as well as other global central banks, from the People's Bank of China to the Bank of Japan to the ECB, they all seem like they're ready to jump on the bandwagon again of record stimulus like the United States over the last few months. So now that we understand there's going to be a lot of funny money, how do we, hedge against inflation to make sure we have wealth preservation at its core? That's the first thing we need to worry about. No matter who you are, your goal should always be to be able to hedge against inflation, because over a 50-year period with 2% depreciation of inflation, you're going to lose a vast amount of your purchasing power. So it's very key to understand how you can get a base yield, whether that be interest in a savings account or what we're going to be taking a look at later on was things like T-bills or treasury bills, how you can actually hedge against that inflation. Now, let's go ahead and talk about savings accounts. The reason why I would personally not have much of my money put in a savings account, I have a little bit in there, but not much at all, is because I'm not getting a yield in that savings account. Right now, the average savings account rate in the United States is 0.09%. You want to know why I hate banks? It's for reasons like that. Because right now, they're taking that money in your account and they're going out and lending it on all types of different secondary markets or right back to you in the form of credit, and they're making 5, 10, 15%. The average amount of debt, the average interest rate that's charged on the overall market of debt is 15%. A bank is making a 15% yield and they're giving you nothing for it. And in a CD, they act as if they're giving you a good yield with 1%. So I stay away from CDs. I stay away from savings account for the most part. If you really want to have a safe and secure yield and just preserve your wealth, this is a general portfolio that I would personally do. First off, I would own TLT, which is an ETF that gives you exposure to a 20-year treasury, which is basically the U.S. government bond. And in this case, you get a yield over time. Treasuries have continued to rise over time, as well as we've been in a positive market for bonds. So you not only get a yield in the sense of the growth of the given treasuries, but along with that as well, you also get the yield on those assets. So that's a good thing to look for. And I would basically have 50% exposure to TLT in this case, or other forms of government bonds. The other thing I would have here as well is another 25 and 25 split, so 25% in gold and 25% in silver. These are both also hedged against inflation over time. Even though they're not providing a yield, they have had nice rallies in the past that have not only compensated for the growth and the dollar supply in the economy, but along with that as well, have also gone up, generally speaking, compared to just base inflation, and have some periods where they really go up during times of fear that can hedge our wealth in this case, and also maybe give us room for growth of our savings. So that's the stuff that I look forward to. That's what I would do: a 50% in treasuries, and then 25% in gold and 25% in silver. That's like the bare minimum risk, putting away savings for a rainy day or for retirement kind of portfolio. But outside of that, if you're looking for a little bit more of a yield, and quite frankly, I personally do, because I'm an investor and I like to do that research and take that extra risk. If I do proper risk management and I know my stuff by doing my research, I like to invest in a little bit more riskier markets. So what would I personally be positioned in? Well, first off, I'd have about a 25% position in precious metals in this case. So I would have 25% split in half between gold and silver. So this gives me a good amount of exposure to a hedging asset, but also one that could provide me some yield in the long term, not so much in the form of an interest rate or dividend, but in the form of growth over the long term. Now, the other 25% that I would have here for kind of an average investor who wants to take a little more risk is obviously Bitcoin. Now, I know some people would say 25% is excessively high, but what you could do in this case is you can have, for example, a majority of that may be exposed in Bitcoin, have some other ones, percentage points exposed into altcoins and other types of cryptocurrencies like Litecoin or Ethereum. And the reason I say that 25% I think is a reasonable level is this is an emerging asset class, guys. It's volatile, certainly, but having it as 25% of your portfolio is not excessively risky in this case. If you have, for example, stops set, so if this were to drop to zero, you're getting out before that happens. And along with that as well, you're able to go through the volatile swings and hold your long-term investments without thinking emotionally. That's two things that you have to factor in. If you can do those, 25% is not crazy. Going all in on cryptocurrencies might be a little bit too much for the average person. Now, the other 50% that we have here to work with in our portfolio outside of cryptocurrencies and commodities are two different areas. I would have some exposure to fixed income markets, TLT, like we talked about. Maybe not just TLT, you might want to have a broader exposure to other government bonds across the world, right? But the last 25% here that we're going to talk about is our exposure to equity markets. Now, in a normal, for example, if we were midway through a cycle or we had just gone through a recession, I would be extremely confident in having 25% exposure to equities. Right now, on the other hand, I can't say that for certain right now. And the reason I say that is because we've got a mass overexposure here, or not so much exposure, but a vast run up here, the longest economic expansion for the vast majority of indices here for equity markets. Tech stocks are way overextended. We've gone from a bottom down here of around 1250 to 1300 all the way up here to nearly 10,000 here in the next coming month, right? We're going to probably be hitting 10,000 for the Nasdaq, doubling the dot-com bubble valuation. So if we keep that in mind here, I would say that I'd probably have 10% exposure to equities right now. And I would find the markets that we've already talked about, ways to expose the other 15% right now until we get a correction similar to how Warren Buffett has some cash on the side. I just don't believe there's much of a growth or set of yield that you can get here in equities right now from the point where we're at. Dividends might be nice. Stock buybacks might be running high right now. But the moment those drain out, you're left with an asset that isn't providing much yield and could drop like a rock at any moment when there's not buyers paying the premium that's been paid over the last few months. So that's my general thesis here, guys. 25% split in equities, 25% in cryptocurrencies, 25% in gold and silver, and 25% in TLT would be kind of my broad asset portfolio holdings. And it's nice. It gives you a good amount of diversity, and not to mention as well some good room for growth, but also a good amount of security for a rainy day in case your riskier assets tend to pull back. That's the general thesis here. And what's nice is you're not letting it depreciate simply by inflation. Between the dividends that you get on your stocks, the growth in high level, kind of new developing assets like cryptocurrencies, the hedging that you get with gold and silver against the depreciation of the dollar, and also the yield, I might have mentioned this, the yield you get on your treasury. All those things combined should help you very much in being able to hedge your wealth for the long term. All right. So that's basically it for the video, guys. Again, the general thesis here is to hedge against this increase on the balance sheet, the increase of credit in the system due to fractional reserve banking. And I hope you all enjoyed this topic. If you liked it, drop a like. As we see central banks continuing to grow their balance sheets, this is going to be more and more imperative. Now, there's one thing I wanted to mention here, guys. It's not sponsored or anything. It's just a really interesting cause that I like. Obviously, I haven't gotten to make much of a comment here on the Australian wildfires. It's been a very terrible situation. I have a lot of friends in Australia. But for those of you out there, I definitely want to recommend, if you can, to make a donation to the wildfire fund here, either through Cointelegraph, or if for those of you out there who like to use Celsius, if you actually take out a loan on the Celsius platform, they'll donate $100 to the Australian Wildlife Disaster Relief Fund. So if you guys want to do that, definitely go check it out. But I think it's a great effort, and I'm glad to see the crypto community stepping up to the plate. All right, that's it for the video, everyone. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.